Greetings. Today we're going to talk about a brief history of money, as very prominently displayed in this title slide over here. And this is a component of the class that I have taught for many years at Stanford University. The title of that class is The New Economics of Disruptive Technologies, and that's why you see this Stanford logo down here in the corner. But the history of money is an essential element of learning how economic evolution occurs and what direction Fintech as well as the technology of transactions could ultimately go in. So that is what we're going to talk about here today. So first we start with this all-purpose slide which relates to all technological change, not just Fintech or money. This is essential to realizing why technological progress is exponential and why most people are surprised by technological disruptions. As we can see here from the cursor, there's a linear trend, and most human beings think in a linear sense. And then you have this curved line, which is the exponential line. And people are usually not trained to think in exponential terms. None of these axes are to scale, but for most of the time, the exponential trend is behind the linear trend. And only towards the end does it shoot ahead and take everyone by surprise. And that is the nature of all technological progress and economic progress. And that is what we are going to see in the evolution of money based on all prior stages of the evolution of money. So what were those stages? We can start over here. In the beginning, human beings bartered, fine. Then came physical tokens, and some of those were beads or shells, but then people got to the point of metal coins, gold, silver, copper, bronze, and so forth. These coins were a somewhat universal medium of exchange that didn't have to be negotiated every single time the way barter did. However, coins were not a great medium because they were heavy, they were very easily stolen, and there was a practice of coin shaving and coin debasement where people would shave off a small sliver from each coin, and if they did that to 20 different coins, they had enough metal to create a new coin, and then a lot of coins would get debased. As we can see from this Wikipedia article over here, titled Methods of Coin Debasement, these are the shavings that people would shave off of a coin. And first you would have a normal sized coin, like where my cursor is. After some shaving you have a smaller one. And after even more shaving you have a smaller one still. Whereas all those shavings were used to be melted and create a new coin. That eroded the confidence in the system because that degree of fraud, which is a significant percentage of the entire value of the metal employed in all the coins of a regime, was pervasive, and it was a pernicious activity that prevented human prosperity from going further because of the problems with coins. So how do you get around the issue of tying the value of a currency to the value of a metal? Well, paper money. Now, paper money started longer ago than you may think. 618 AD. That is 1403 years ago. It started in China. But there were many reversals in the progress towards normalization of paper money. Every time there was a war, the currency notes of the old regime would become worthless and the new regime would not recognize them. And many wars were fought over the validity of paper money. People died over the issue of the adoption of paper money, and it took many, many centuries. Believe it or not, the United States did not have paper money in terms of universal US dollar bills until 1862. That's right, 1862. And if you see a Western film from before that time, you will see that most money is in the form of gold coins. They had banknotes then, but banknotes were very illiquid because they were dependent on the solvency of a particular bank. And if the reach of that bank was not nationwide, then the banknotes issued by that particular bank did not have complete validity across the entirety of the United States. So actual dollar bills in terms of currency were not used in the United States until 1862. And then electronic money arrived, and even that started a lot earlier than you may think. Electronic money goes back as far as 1861, believe it or not. But even so, many innovations in that were very recent. When e-commerce began in 1996, 1997, Amazon.com and so forth were places where you could buy things online. People were afraid to send them their credit card number. People were afraid to put their credit card information on the internet at that time. Young people may not know this, but this was very much a fear as late as 1997, 1998. And therefore the technologies around digital authentication and security and anti-fraud measures became very robust, and e-commerce became normalized, and all these large e-commerce giants could come into being. And not just Amazon, but even Apple with their iTunes, Google with AdSense payments, and so forth. But there was a lot of infrastructure that had to go into making those types of transactions valid so that hackers could not continuously defraud everyone under an electronic payments scheme, and people putting their credit card information on the internet and transacting over the internet with their bank account and credit card details. So even though it started in 1861, even in 1997 it wasn't really that robust. And even now in 2021, there's still continuous improvement. It's not perfect. There are all kinds of fraud and scams that continue to go on. And now we arrive to 2009 in the final entry here, which is cryptocurrencies. That's where I disagree with this slide, because it is not cryptocurrencies that is the innovation of money. It is the simplification of money into data that is the real revolution. Cryptocurrencies are an unnecessary product layer that is perhaps helping move along the transition of money into data, but is not the final solution and is not even a necessary layer. For example, the biggest and most famous cryptocurrency, Bitcoin, has a number of problems that make it unviable for any long-term use. One is that its ledger is too energy inefficient. And in fact, the Bitcoin ledger is thousands of times more energy inefficient for each transaction relative to the Visa credit card network. On top of the fact that Bitcoin mining uses 0.6% of all the world's electricity, which is about as much electricity as a country the size of Spain, for example. That is how energy inefficient Bitcoin is. The second problem with Bitcoin is that its ledger does not even do smart contracts. And smart contracts are essential to any automation of money that is to eventually occur. That's why Bitcoin is famous only because it's first, but it is in fact the most technologically obsolete of them all. And the people who are very enthusiastic about Bitcoin don't seem to be able to produce any counter arguments to that point. Now, cryptocurrency as a whole is another problem, just because there's hundreds upon hundreds of new cryptocurrencies being created every month. There's in fact over 11,000 that are active right now. So each one is in some ways built around the premise that it will achieve critical mass, and only under achievement of critical mass does their business plan make sense. But obviously all 11,000 are not going to be able to do that. So there's going to be a huge consolidation in that space. So I'm not a fan of cryptocurrencies at all per se, and you can see this video over here where I talk about that some more in this card. But what will happen is the evolution of digital rights and security and distributed ledger recording of transactions to a point where all those security and authentication and recording protocols are extremely robust and super low cost, and therefore you have simplified money and transactions down to mere data, and that is the end game. Because once you have made money into data, then all kinds of other things that we talk about in the Atom publication become more seamless. For example, the continuous increase in money supply through central banks, because all that money supply is merely offsetting technological deflation. That process becomes more diffuse and more easily assimilated into the rest of the economy, for example. And therefore that is a huge improvement over the ultra blunt instrument methods that the central banks of the world are using right now to increase liquidity, but not have that liquidity actually go to the right place, and therefore they create market distortions all the time. So that is where the evolution of money is going. The transition of money into data, which does not require cryptocurrencies per se, but is nonetheless going to be a place where a huge number of new fortunes are made simply from this transition, just like the other several transitions before it. So down in the description box below, I'm going to have links to the Wikipedia articles that I put into, including the one about the history of money, where you can see how it took centuries for each of these prior ones to get to critical mass, and we will not have the same centuries of time frame for the digitization of money because of the accelerating rate of change and the exponential nature of technology that we saw earlier in this video. And this topic will be revisited in other fintech related videos as well. But if you like this type of content, I encourage you to subscribe to this channel, and thank you very much for watching.